two simple words that cover a world of opportunity. Like all trading, financial trading is about exchange and ownership, the buying and selling of financial instruments. These instruments can be cash instruments, such as shares, currencies, and bonds. Or they can be derivatives, such as CFDs, futures, and options. Financial trading encompasses the full range of possibilities for trading in the financial domain. Whatever the instrument, the idea is always the same: to benefit from movements in price. If you buy low and sell high, you profit. Sell lower than you buy, and you make a loss. Sounds simple enough, but there are millions of individuals, companies, institutions, and even governments all trying to profit at the same time. Many prices are always on the move, and the bigger the movements, the more volatile the market, which could provide more opportunities to profit, but also increase risk. Financial trading is normally carried out in one of two ways: via an exchange, a highly organized marketplace where members trade a specific kind of instrument. For example, US shares on the New York Stock Exchange. Or over-the-counter, where trades are made directly between two parties, like when you trade currencies at the airport or buy and sell CFDs from your provider. Then there are different kinds of trader. Some stick to a specific kind of instrument or asset class. Others have more diverse portfolios. Some like to immerse themselves in research, scouring the news and financial reports to find their next trade. Some others base their decisions on statistical trends. Some take lots of short-term positions, opening and closing trades in a matter of days, hours, and even seconds. Others take a more long-term view and hold assets for months or years. But all traders share one thing in common: risk. It's essential to balance the potential for profit with the possibility of loss, because that's what financial trading is all about.